Rich, this reminds me of is some late night disc jockey in Iowa somewhere, just playing exactly what he or she wants to play. So, anyway. So, Rich, did you leave the conference on Wednesday? Rich can't hear me. He's too busy listening to Eric Church.
I'm sorry, I totally couldn't hear anything.
Oh, did you fly out of San Diego Wednesday?
I did, yes. Wednesday morning, and with no problems. So one layover. I flew to LA and then the long LA to Cleveland flight. So where'd you go after San Diego?
I went to Reno, then to Truckee, and now I am in San Rafael, California. But next Friday will be a little bit of a surprise.
Next Friday, when we have your friend, I've never met or talked to her, but respect the hell out of her, Ivy Zellman from Zellman and Associates, Clevelander.
Next Friday?
It's next Friday. So, and Rob from a secret location. So, all kinds of excitement next Friday.
Yeah, you'll never be able to guess where I'll be, but anyway, that aside, a few people like to know what we might be talking about on any given Friday, and a couple of people wrote to me, and I said, this is like when parents don't find out the sex of their baby before it's born. I have no idea what exactly you want to talk about today. So this is going to be a big surprise for everybody in our in the room.
Reveal party. Yeah, there's not a lot of show prep going on here. Occasionally we'll shoot a couple of emails back and forth. If we have a guest, we got to prep a little bit, but stream of conscious discussion about whatever we feel is most relevant, I guess. So sometimes
they don't have Tourette's.
Exactly. So happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, our weekending foray on all the latest happenings in the mortgage industry. And Rob, this week, MBA Annual, the largest annual gathering of mortgage bankers each year. This was the first big mortgage conference in at least a year and a half. And a lot of people there. It was great to see everybody. A lot of people we haven't seen in a long time. And I'll avoid the confusing, controversial opening question and just ask you your immediate, most notable takeaways of the week.
Well, it was memorable sight seeing all those mortgage bankers doing the snake dance through the lobbies of the various hotels, and who knew Bob Brooksmith was so good at doing the limbo. But that all aside, I thought it was a very good event. I thought that there were basically 2 years worth of saved up, pent up conference demand going into that. Now, granted, many smaller organizations have had conferences ahead of this week's MBA, but nonetheless, just the event itself, I think, meant a lot to a lot of people, and it reminds us that we are in an industry with a lot of pretty cool people and people that you want to see and hang out with, and not necessarily on a Zoom call. To be able to shake their hand and see them from across the room and just walk up and say, "How's it going? How you doing?" Beats the heck out of a Zoom call. Not that I'm downplaying what you and I do on Fridays like this, but and certainly this helps folks who couldn't make it to San Diego. But nonetheless, like I said earlier, it reminds me of just what a people business this is, whether you're dealing with borrowers or you're dealing with people in the industry, whether they're your friends or new acquaintances or friendly competitors. The the ability to sit in a room and might be talking to you, and then somebody comes up who knows me, but they don't know you. And I say, you know, Josephine, you know, here's Rich, you know, wow, Rich, you know, I've heard of you. That kind of thing just doesn't happen much on a Zoom call. So it was nice. What was your experience like?
It was great. Yeah. I mean, it was great to see a lot of people and, just a lot of good meetings and, using events like this to just take the pulse of the industry and continue to assess ways that we can be really relevant to the members and get inside their heads as to what they're thinking about. Some of the things that were, to me, prevailing trends on what people were talking about was, just in general, I think battening down the hatches for, the era in front of us, one that is likely to not have a lot of refi and a purchase market that is challenged, and unprecedented amounts of lenders either recently having or ready to make decisions on tech vendors, systems, platforms. A lot of people looking at LOSs, new LOSs, a lot of M&A talk. Holy crap. I just really, we've talked about this before, kind of anticipate that we're going to see a lot of mergers and acquisitions in the mortgage industry, these next 12 to 18 months. But that was something I heard a lot of. MSR sales, the demand out there right now for buying and selling MSRs, all this low rate, 30-year fixed rate stuff that people have been slamming on the books that is likely, we've said this before and been wrong, but likely to stay on the books for a while, making it valuable servicing for acquirers, and also presenting an opportunity for some fee income for originators that maybe have more of it than they're comfortable. But those were some of the things that jumped out at me in terms of just, prevailing trends, what people were talking about.
Yeah, I would say that all that, the M&A activity, there are a little few snippets, and I certainly noticed the increase in vendors relative to lenders. And I know TMC does a very good job of trying to maintain a balance between vendor membership and lender membership. Say that 3 times fast. But a lot of vendor activity and a lot of talk out there, though, about, we had a great 2020, but that was then, this is now. And, we were going to send 10 people to this conference and only 5 went because we're already cutting costs. So it doesn't take long for mortgage companies to scale things back and stop spending money despite having a fantastic 2020. So we'll see, going forward how that works out. But the overall mood was very good. I've published in my commentary the names of some good vendors that are out there. And let me start that all over again. In my commentary, I published the names of vendors, some of the more interesting ones that I had never heard of. We were walking down the street. I was walking with some Wall Street buddies of mine, and there was a company that is into web security, cybersecurity. And so we talked to that person for a while. That's just not something you get in a Zoom call. Like I said earlier, it's like a serendipity. It's like just kind of a happenstance that you end up learning things by being somewhere that you don't get on a scheduled call. But certainly the vendors that are out there are really striving to pick up some market share. I spent some very nice time, about a half an hour, just he and I speaking with the CEO of SnapDocs. And it turns out he has a house near mine and is remodeling his house in Reno. And I'd never met him before. Good guy. We had a good conversation about travel and about venture capital versus private equity versus public ownership. And those are the kinds of things that you don't get once again in a scheduled call. I liked him. I'd like to think that he likes me, and we're going to stay in touch, I hope. But just a good guy. And things like that are very interesting. And obviously SnapDocs is one of those companies that seems to be going places. So how was the TMC reception itself? Was it well attended? Unfortunately, I won't say I made a mistake by staying to the end of Pitbull, but I probably would have had more fun at the TMC Lou and Mickey's extravaganza.
Yeah, it was awesome. There were so many people there. Holy crap. I think there was like 2 waves of people coming from the Pitbull concert. The first hour, it just slowly got busier and busier until, like it was almost filled. And then I just remember turning around at like 10:15 and it was like a bus had let off like 200 people. And then we got like another wave, like close to when it was supposed to end, like 11. So I didn't stay too much past 11. I had a million meetings in the morning, but allegedly it went till 12:30. Our CEO, Jim Park, extended the open bar a couple times and was still
I'm stunned.
Yes, right, exactly. Very surprising. Yeah.
Can't see Jim doing that. Did you have a chance to meet my son, Robbie? He was there.
I did not. And I was trying to get around and just talk to people, but it was very tight packed and, tough.
Yeah, he and I are, some people think we're twins. We're almost identical, except he has a lot more hair. He's better looking and in better shape than I am, and 32 years younger. So aside from that, we're almost a dead match. But he said he had a good time there. So next time you'll have to meet him.
Yeah, sure. It was a good time. It's high caliber of people always at our events, which is nice. So
you were probably in the meetings and not so much the sessions, the actual sessions.
I popped in just a couple general sessions for pieces of it. I did get a chance to whirl through the expo hall, and like in my mind, I should know every vendor in this industry just in my role. And I was shocked at how many I didn't, between just assessing vendors for TMC and also our emerging tech fund. So I was shocked at how many startup companies there were in the expo hall. And, when I mentioned M&A earlier in the show, I was referring to lenders and vendors. I think you're going to see a ton of it. There was a couple announcements at the show of some pretty prominent companies that kind of folded into one another. And, I think that if you're a small company, either an independent mortgage bank or a vendor, you're looking to a lot of them are kind of looking to latch on with somebody that's got the chassis for the future. And those companies, I think, are looking for, acquisitions that make sense as well. So that was one thing that stuck out to me.
Did you get the sense, Rich, that the vendors are continuing to distinguish themselves between, how do I put this without offending, half the crowd on this phone, but there are some third-party providers which seem up and coming or continuing to succeed, and those that perhaps are in desperate need of a new product, shall we say, or maybe getting a little bit tired. Are you seeing kind of that difference going on out there with third-party providers in general, or TMC members?
Yeah, without a doubt. I think that it's tough to be like, there's been some great companies that have done like one thing well and have been real successful and added clients, and you continue to thrive, or, exited and folded into a bigger company. I think that's going to be tougher going forward. I think that we're just kind of heading into this era where you've seen some really good companies that were out in front of this emerging tech wave. Obviously, Ellie Mae and Black Knight and like the Simple Nexuses, and SnapDocs is one you mentioned that's doing some good things. Like, they're amassing customers and doing some really great things, and they're making strategic acquisitions as well. I think some of these POSs are starting to become full end systems. And I really think, like, when you look into the future, loan origination systems 5 years from now, it's probably going to be Ellie Mae, it's probably going to be Black Knight, and it's probably going to be some of these other platforms that are acquiring customers very quickly that aren't currently loan operating systems. So I would say growth by acquisition is a smart strategy in mortgage lending. And I think Black Knight is evidence of that. They've made some really smart acquisitions that have contributed to recent growth. Love their stock, by the way. Any stock market players on? I think you look 9 months out. That one's going to be nice. But yeah, so we'll see. Who knows? Just my opinion.
But as we know, Rich, that past performance is no indication of future gains or losses.
Right, and that is not financial advice. All the disclaimers. I don't know what I'm talking about exactly. Yeah.
I saw you on the Black Knight boat. You had the little Gilligan's Island skipper's cap on, and you were surrounded by a bevy of beauties, or maybe grizzled mortgage bankers. I don't know, one of the two.
One of the two, right? Exactly. Yeah.
On board there, but I didn't see you with a skipper's cap on, but I did see you briefly, and you were surrounded by people, so I couldn't get near you to say hey. Yeah, I would say that some of these companies, Simple Nexus buying LBAware, for example, Black Knight buying both Compass Analytics and Optimal Blue. It'll be interesting to see between now and the next MBA conference, which is in Nashville next October, which is really a dreary city. There's no celebrations there, no bar, there's no restaurant scene in Nashville, right? So it'll be interesting to see if some of these aggregators, or I should say some of these vendors who have been aggregating vendors and third-party providers, continue to grow, or maybe they get so big that they feel that they have all the bases covered and don't want to grow anymore, and they're just going to continue to improve their product. But the whole point of what I see them doing out there is trying to reduce this friction, which way back when Angelo Mazzillo talked about at Countrywide. He said, we're just trying to reduce the friction. And I said, what do you mean by that? And he said, it's a not a good process. It's not a smooth process between application and funding a loan, and then putting it into servicing. He said, so much of what we do is trying to reduce that friction while the loan bumps along through, getting the credit report and the appraisal and getting all the documentation, and then the rate lock and what kind of program just kind of bumps along. And then from a borrower's perspective, sometimes they're dealing with movers and dealing with inspections and appraisals that don't come in at value, et cetera, et cetera, et cetera. It's a very complicated process. And I think the vendors that I've seen out there who are successful oftentimes take personnel from the lending industry and hire them or bring them in on a consulting role. I've done some capital markets consulting for companies who are like, what is capital markets? What's the difference between a Ginnie Mae and a Fannie Mae and Freddie Mac and a private label security, et cetera, et cetera, et cetera. So they bring me in to kind of educate them. But many vendors out there have been hiring from the lending ranks, because who better to help improve the process than somebody who had to deal with it? And so I think the efforts that we're seeing out there, the success that we're seeing out there, aren't necessarily purely by people who come out of Harvard IT department, graduating with a degree in IT, and they're going to suddenly set the world on fire, and they're going to change the mortgage process. The third-party providers I see out there who succeed might have that as kind of a backbone, but they bring in people from lending, because those lenders, whether it's a loan officer or a capital markets person or whoever, they know the business, and there are reasons why things are done a certain way in our business, and we on the call understand that. Somebody with an IT degree from 3 months ago might not understand that so well, and so the good companies out there are able to meld the two and blend the input from all parties and come up with a product that come up with products that really work. So it is fun to watch some of these vendors, LBA Ware grow and grow and grow. And now they got bought by Simple Nexus. It's fun to watch companies from my perspective who I think, yeah, that's pretty nifty. Why didn't I think of that? Or even if I had thought of that, it's pretty neat to see somebody execute and then succeed. And I think we'll see more and more of that as we go forward. And especially if some of these vendors are purchased by larger shops, larger third-party providers, it'll be even more interesting. I don't know. It's always an interesting business, right?
Never a dull moment. And yeah, I agree with you. So this is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Chrisman, just kind of recapping our thoughts and takeaways from the MBA annual convention earlier this week in San Diego. Some new stuff, some announcements, as always, Rob. At MBA, Sandra Thompson spoke and announced some changes with Fannie and Freddie, some relaxed guideline stuff for refi now and refi possible, allowing up to 100% area median, allowing desktop appraisals to continue, another no-brainer, but something that was met with pretty loud applause. And the projections for the MBA, Mike Fratantoni, I mean, this blew me away. All the projections are starting to come out now for next year. You got on interest rates, Fannie Mae is projecting an average of about 3.3 on the 30-year fixed rate next year, just slightly higher than we are now. Freddie Mac currently projecting 3.5%. MBA projecting rates to go up to 4% to 30-year fixed, like by early fall next year. And it was very surprising to me until I thought about it more. And think about it. If you're MBA, one, you want to, you don't want to overshoot on your projections. And think about it. I read that when it really set in was the next morning. I'm reading the news headlines. Fox, CNN, MBA economist projects 4% 30-year fixed rates next year. Refinances, right? They're pumping more volume into the industry. No,
they are to some extent. I think, as we've talked about on the show a few times, you get into a situation where there's refi burnout and there's so many people out there with 2 3/4 or 2 7/8 30-year fixed. They aren't going to refinance for rate and term, but they are going to, at some point, the odds are good that they're going to need a cash out refi or head towards a HELOC or a second. And what I was hearing were lenders asking me about HELOC programs and second mortgage programs. And, we put thousands, particular CEOs saying, I put hundreds or thousands of borrowers into 30-year fixed rate loans, and they aren't going to move. They like the school district they're in. They like the neighborhood. They aren't going anywhere. They got a great rate, but they have, credit card expenses or, college expenses, or they want to buy that, Mercedes Sprinter and tootle around or something, or whatever it might be. They're going to need some money. And so the thinking is, all right, what can we do to help our previous borrowers with their money needs? And that's where banks, frankly, have some advantages, because they have some programs out there that can help their existing clientele with cash needs like that, whereas an independent mortgage bank is going to have to rely on their capital markets staff to bring in some programs that can help. So it'll be interesting. I don't know. We keep underestimating this market. I was not to name names too much, I guess, but I was on a panel with a well-known person associated with MBS Highway a couple months ago, and the broker audience was eating up him talking about a 1% 10-year yield by year end. And I'm sitting there thinking, I just don't see it. But, who am I, right? The people who make predictions, in the MBA, you got to give Mike and Joel and Marina credit for changing their predictions regularly or revising them. because predictions, I think there's an old saying about God's laughing at God. The gods laugh at anyone who makes a prediction or something like that. And I tend to stay away from making too many predictions because people come back and they'll say, well, this is what you said. And I say, yeah, I guess I was wrong. Not that the Fannie Mae or the MBA or Freddie Mac are ever wrong, right? But nonetheless, I think the good companies are going to continue to originate a lot of loans out there, and maybe it's the expense of the smaller, less efficient companies that are out there. And it doesn't take much market share. I was saying this years ago. It doesn't take much volume from Wells Fargo. If Wells Fargo decides to pull back from their residential originations, it doesn't take much of a pullback to make for some really great years for a lot of small independent mortgage banks or credit unions or small community regional banks when a big player like Wells pulls back. And that's what we've seen here in the last year or two or three is Wells Fargo pulling back. They aren't the number one lender in the United States anymore. That's gone to an independent mortgage bank. And so we could see some big bank gyrations, which will help TMC's members in the next year or two. So it'll be interesting. Always is, right?
Always is. And yeah, the rest of the MBA projections they announced for next year, total originations, which was another stunner, just according to people I talked to. Fannie right now is projecting 3.3 trillion next year in 22. Freddie projecting 3.1 trillion. We're going to be at about 4.4 this year. MBA predicting a drop to 2.6 trillion. That's a big drop off and a far departure from where the GSEs are at. Home price appreciation, MBA 5.2% they're projecting for next year. Fannie's at 5.1 for their 22 projection. Freddie Mac at 7%. So for whatever it's worth, the 2022 projections are all out there, and Fannie is the most bullish, MBA is the most bearish, and we'll see what happens. But the HELOC thing to me is fascinating because people have gobs of equity. We've chronicled it before, all the reports and stats that are out there. The purchase market is still challenged. So I think a lot of people will opt to improve their existing home maybe next year as opposed to buying a new one. And, cash out refinances, you can only go up to 80% and you have to refinance your rate. And if rates are higher, it's going to make it negative to do that. So I wonder if just the banks, their appetite for HELOCs and seconds and how that's going to shape up against the demand, which I expect to be great demand, maybe the greatest demand ever for HELOC and home equity lending these next couple of years. Will the banks be able to satiate all that? And will any good secondary market, there's really no good, if you're an independent mortgage bank, no super viable outlets in the secondary market for like standalone HELOCs. So maybe that's something that will develop next year.
Yeah, well, one could argue it's already developed. There's a company out of Atlanta called Symmetry, which has a HELOC program. In fact, I think I had an ad in today's commentary about it. I think that's something loan officers might want to acquaint themselves with. But yeah, there is opportunity. We have an industry that's filled with some very intelligent people and very competitive people. And so, and they want to help borrowers and they want to make money and they want their borrowers to do well and be better off financially. And so, yeah, where there's a will, there's a way. I think we're heading that way as we always do. We're pretty nimble as an industry.
Any other takeaways for you, Rob, from the week? Anything else that stuck out to you just in terms of what lenders we're talking about or what you heard and saw?
Yeah, I spent some time with the crew at PenFed correspondent talking about jumbo programs. The DU driven underwriting of jumbo programs is that's a conversation topic out there. Once again, trying to reduce that friction between application and funding And one way to do that obviously is during the underwriting process. And gee, if it's good enough for Fannie, it's good enough for a jumbo player. And DU is something that private label security buyers understand. They understand what it's like to have a loan underwritten and approved by desktop underwriter. And so to be able to apply those algorithms to a jumbo loan can make a lot of sense, and it makes it easier to do jumbo loans. So that was another big topic that I heard in the hallways out there, people talking about that. But really that was, yeah, I mean, we hit the high points. I mean, there's a lot going on. It's a fun business to be in. You know, what can we say?
Jumbo construction and HELOCs, typically three products that there has not been a very liquid secondary market for, all stand to be much bigger parts of the pie as we move forward here into 2022 and beyond. So it'll be really interesting to see how that all plays out.
So I've got a question about conforming loan limits. And I keep making this point in my commentary. Sometimes I think I'm yelling into the wind. When the Fannie Mae and Freddie Mac, or I should say the FHFA, just as a reminder for everybody, I know that PennyMac led off the show by kind of jumping the gun to some extent and talking about new loan limits for their programs, and then other lenders and investors followed suit. Historically speaking, Fannie Mae and Freddie Mac come out with their new loan limits for the following year right around Thanksgiving. So we got about a month to go before those officially come out. Now they may come out sooner, but that's traditionally when FHA says, okay, here are our new loan limits for the following year. We've seen such appreciation in this marketplace over the last year, though, that these investors and lenders have felt safe in coming out with their new conforming loan limits. They also have the financial wherewithal to hold on to some of this product until Fannie Mae and Freddie Mac start buying it themselves. So to be able to use DU or LP, underwrite these higher loan amount loans, and then deliver them into securities, into agency securities starting in January, I think has been an interesting topic. I raised the point, though, what's to stop somebody from doing it starting in July or August of next year? So I think it's a brilliant marketing ploy. It certainly has the industry talking, but smaller companies, you don't want to be sitting out there having changed your loan amounts and have something go awry, and you're stuck with an unsaleable loan or something that you get a price hit on. But yeah, it's an interesting marketing ploy and certainly turned a lot of heads. And we'll see where the agencies actually come out at the end of November with the 2022 limits. But that was something else that some folks were talking about. But more the capital markets folks kind of said, we get it. That's a choice that they're making, risk return kind of thing, probably safe in given the appreciation the market has seen to raise those loan limits up a little bit and get some headlines. But anyway, that was something else that was being bannered about in the hallways.
Yeah, I know. Speaking of headlines, many expected a headline that could come out of this MBA annual conference was for Ms. Thompson to announce the reduction of loan level price adjustments, something she's referenced before as a way to help, spur lending for those kind of on the fringes where, the LLPAs are the most penal, but nothing there, no announcement there as far as any changes to LLPAs. And have another comment in the chat. Any comments on recent CFPB, DOJ, OCC disciplinary action taken against a bank? It's the first action of this kind we've seen in a while, a sign of what's to come. The short answer, yes. I mean, I think that you're going to see enforcement actions and the low-hanging fruit at first that will get people's attention and start to inspire behaviors. That's just part of the regulatory pendulum that is now at a different end than it was before. But Rob, any thoughts on any of that before we take it to the weekend?
No.
No.
The CFPB is I think we're coming off a great 2020, 2021. There is fear out there that when the agencies really start to underwrite some of the production that they've been buying and not necessarily taking a hard look at, there are going to be some buybacks. Some buybacks will pick up. Some things will be perhaps not necessarily underwritten correctly or processed correctly. There's some chatter out there, but there's also chatter, as you point out, about the CFPB and enforcement actions and so forth. But I just can't see the industry being crunched by the CFPB like it was under Richard Cordray, because the starting point, what this industry has been doing for some years now, is far and away much better than we were doing in 2005, 2007, 2008. So the starting point for us in terms of enforcement actions, I'd say we're just a better industry than we were back then. So there's less really to, for the CFPB to go after. But they'll get headlines. That's for sure.
I completely agree. It's so much more compliant of an industry, even than during the Cordray CFPB. So there will be enforcement actions, because there's a lot of stupid people out there that, again, low hanging fruit, and, just pluck a couple of those pieces of fruit off the tree. And it's a way to help inspire behaviors from maybe those on the fringes. So one more comment in the chat, Rob, the PennyMacs of the world raising, and lenders out there raising the conforming loan limits. What happens if it is less than 625? People are originating conforming loans at 625, and say they come out and say it's 590. You got a bunch of loans at 600, 610, 625. What happens in that scenario?
You figure that's a jumbo, or that's a super conforming, or whatever your nickname is for that, high balance conforming, and it gets capped out at 10% of the delivery. So, yeah. Or you take a price hit. So, but it's a calculated risk that these companies are taking. It's probably a safe bet, but yeah, they could end up with some price hits along the way. But I think they're erring a little bit on the conservative side. We have seen so much appreciation; they're probably okay.
The weekend, I got date night with my 13-year-old daughter tonight. Going to a nice little Italian restaurant and probably watch some horror movie at home after that, and going to Cedar Point tomorrow, the greatest amusement park in America. It's about an hour away from me. And any good points this weekend?
To return briefly, Guy Schwartz just popped up that not all counties have high balance, and Guy's right. You could originate a new and improved conforming loan amount loan in a county without a high balance number, and you're not going to get stuck with it, but you're, it's a calculated risk. Plain and simple.
Ohio. I think there's one county in Ohio that has high balance limits. So it's
For me, I'm playing hoops tomorrow morning, and just taking care of errands ahead of going away on assignment for next Friday's show.
The secret location next Friday, Rob Chrisman filming from somewhere to be determined. And again, we have Ivy Zellman on next week, who is one of the leading housing people in America. Zellman and Associates. She's always on CNBC and Fox and CNN as their housing expert. She's very notably predicted some of the yet to happen huge swings in housing before it happened. And she recently wrote a piece that differs greatly from what Rob and I have been intimating, that America's underbuilt. She is making the claim America is overbuilt, that there's too many homes that are built. So should be very interesting conversation next week.
It'll be contentious.
She's going to love my background, though. She'll know what city that is for sure.
There you go. Well, Rich, thank you for having me again, man.
Yes, as always, Rob, enjoy the conversation. Many thanks to all of our attendees, the audience just keeps growing each week, which is great. We're very appreciative, and we'll continue to try to make it relevant and not take ourselves too seriously, and continue to be back here live every Friday at 3 p.m. Eastern for the Rundown with Rob and Rich. Of course, we also make these into podcasts, and that's where we get the most listens by far. So if you're not subscribed, go to Apple or Spotify, search TMC, subscribe to our podcast. You can listen that way as well. And we post these as well to our YouTube page, where a lot of people watch the video after the fact also. So until next Friday, Rob, have a great weekend, and I will see you in 7 days.
Very good.
Bye-bye.